Hi, everybody. It's Dr. Robinson. It is the December 31st, 2022 meeting of the Money Masters Investment Club. And of course, this will be our last meeting of the year. So let's kind of get to it. Our itinerary is not that much different than it normally is. We'll look at our financials. We'll do another bond market update. And this is the end of the fourth quarter. So I just want to let you know that we will be getting our statements out in the next couple of weeks or so. So expect to see that in your email coming up. We had a pretty good week for the week, despite the fact that it was Christmas week, or actually a holiday week, and the markets were relatively muted. Not a lot of volatility, but we did have a starting NAV at 25.90 on December 24th, Christmas Eve. We gained for the week 61 cents. We ended the week at 26.51. That comes out to a 2.36% increase over what we started with. So overall, pretty good week. The markets were relatively muted, so we didn't get a lot of chances to trade this week. I don't know if that's going to continue going into next week. It usually takes a week or so for the markets to kind of get back into work mode as opposed to holiday mode. So we're coming out of holiday mode, going back into work mode. So the volume should start picking up in the markets again. So we should see some increases or more opportunities at the very least to increase our activity, increase the number of contracts we buy and the number of trades we actually take. So overall, pretty good week, pretty happy with it. We still have a strangle going on, guys. So as you can see, the calls are out of the money by $2.04. The market has been going down, so calls, as you might expect, are losing value, but they're being offset. The losses in value are being offset by the gains that we're getting in the puts. So our puts are growing about 1.5 times faster than we're losing money on the calls. So all in all, we're doing pretty well there. In the next week or two, it might be a little longer, maybe a little shorter. I'm not sure yet. We will probably have to redo our calls. Don't want to get or have the calls lose so much value that the delta falls too far, because it makes it more expensive to try to fix that in the future. But again, we'll know more as the market goes on in the new year. We are now coming out of the holiday season. We should be getting back into normal trading in the next week or so. Let's call it week to 10 days. It does take about a week for the market to kind of get back up to speed. But the holidays are gone, and most people, especially investors, are going to be getting back to work. And so we should see the volume coming up. So we'll see if the bulls can do anything over the next few weeks to try to get these calls back up. But if not, we're happy with the puts. Our puts are growing quite a bit faster than we're losing money on the calls. So all in all, our net unrealized gain has grown to just under 200,000, and we're in pretty good shape on the strangle overall. So I'm pretty pleased with what's going on there. So guys, here's the slide that we have looked at over the last year or so as we look at bonds and bond rates to see what the Fed is doing with interest rates. Nothing really important to talk about here. We're starting to watch the yields, especially in some of the shorter instruments, climb a little bit. You will notice that on the 4-week T-bill, we're up 32.3 basis points. That's a pretty big jump, but it's only on one of the T-bills, and it's on the shortest of all the T-bills. It's a 1-month T-bill. So it's nothing material that we're going to worry about. It doesn't kind of bode anything for the economy or anything. But it was a pretty dramatic rise in yields on that 4-week T-bill. The other T-bills, 3.9 increase on the 3-month T-bill. The 6-month T-bill up 10 basis points. 1-year T-bill up 6 basis points. So again, for those bonds, nothing really major going on. Not entirely sure why the 4-week T-bill jumped the way it did. It might be that there's just not enough investors. The dollar has been coming down, and that might mean there's a lot of investors that are just not interested in a 4-week T-bill. And so to compensate for that, the Fed or the Treasury actually had to pay out a little bit higher yield to try to draw in some investors. That's probably the only reason we saw that happen. If it were anything more fundamental, we probably would have seen increases in the 13, 26 week and the 52 week bonds as well. But we really didn't see anything material there. The mid-level bonds, what we call the T notes, the 2-year, 3-year, 5-year, 7 and 10-year treasuries, all up about, I'm going to call it 13 basis points over the last 7 days. Nothing really here major again. So the bond market's pretty stable right now. And then, of course, on the T bonds themselves, and right now we only follow the one T bond, the 30-year bond, 14.8 basis points. Again, nothing material about that. So interest rates are going up a little bit. That does mean, by the way, remember, as rates go up, as interest rates go up, rather, prices come down. So bond prices have come down just a tad, but again, nothing material here that we need to worry about. So all in all, pretty calm week in the bond market, other than that 4-week T-bill. So nothing really here to report. So guys, the last slide I'm going to show you is just a slide wishing you a happy new year. 2022 has been a pretty good year for us. Overall, we've had a really good return on our positions. I think that's going to continue well into 2023, no matter whether we go into recessions and stuff. I don't care what we don't care whether the stock market goes up or goes down, because we can take advantage of it either way. We're going to continue doing what we do. I'm hoping, or my goal here for 2023 is to double our accounts again. We a little bit more than doubled in the last year or so. So I want to try to continue that and get us back to or doubling again in 2024 or 2023 rather, and maybe even into 2024. Who knows? But at the end of the day, I do want to wish you Happy New Year and a prosperous 2023. I have not done any other slides on this one. Sometimes I talk about some other things that I'm looking at. What I thought I would do from now on, guys, is that on Saturdays when I do these meetings, I'm just going to do our kind of our nuts and bolts stuff. We'll look at the NAV. We'll look at bond prices so that we can kind of see what's going on in the bond market. But other than that, I don't see a real need to cover any of the other things. And the reason I decided that is because I do need some other content. So I'm going to be doing some shorter videos on stuff that's interesting and that I think might have an impact. So I had somebody pose a question to me about inflation in the M1, M2 money supply, and I thought that would actually be a good video to talk about. So I'm going to work on that over the weekend, I think, and maybe post that to the sites on Monday or Tuesday of next week. Give you a chance to get my view on other things, or the things that we follow typically that I might talk about in these meetings, but kind of do it in a way where you don't have to be on a video for 45 minutes to watch me or listen to me talk. So I can do maybe a 5-minute video on why I think that the M1 and M2 is where it's at, and whether it's going up, going down, where interest rates might go from this, and any other things we might talk about. Several weeks ago we talked about Italian banks. You had to get money out of Italian banks if you had money in a bank, and that's the kind of stuff that we can do on a 5-minute video instead of having to do that part of a big meeting here. So we'll be doing that in the future going forward, just to make the videos more frequent but shorter, because frankly I don't have the attention span really to do the long videos anyway, and I certainly don't listen to them because they're too long. So you're probably in the same position. So going forward, we will be doing more frequent videos, but much shorter. So having said that, guys, Happy New Year. Be safe, and we'll see you next year.